The CPA exam is all about auditing. That's what you get a license to do. You get a license to audit. And so what I'm going to do is go through an international case. It's very similar to the U.S. cases, but doing the auditing for the some things you might look at for auditing of an international client. And the reason I do this is well, two reasons. They have stopped. They used to do on the CPA exam, they do a kind of like a comparison. What's different about the international standards than the U.S. standards? And they really don't do that anymore. They're more focusing on, they'll still ask you international standard questions, but those questions will be on simply the international standards. Like, it won't be saying compared to the U.S. standards. It'll be, okay, if you're doing this audit to international standards, what would be the procedures for this or that or the other thing? So they're, which I think is a better way to do it anyways. It's it kind of shows you that the process is the same. You know, there may be a few quirks, a few differences, but the process are the same. So anyway, we're going to go through a small family-owned business, going through an audit, and just kind of pick up some of the things you might do as an auditor. And if you haven't had auditing yet, and I know some of you haven't, this is kind of aimed at kind of introducing you to it. And basically what auditing is when someone puts out financial statements, they have auditors come in and make a report on those financial statements. And that's all the CPA license allows you to do. It says you can do audits. And that audit report goes along with those financial statements. And it's the same thing for international standards. The report is very similar. It's you know, the report that you give at the end of the audit, it's very similar to the U.S. standard one. A lot of the processes are the same. So anyway, I thought that we just kind of go through there. And again, this is, while it is international, it's also applicable to U.S. standards, because 95% of it will be, you know, the same. Okay, as you did not get this case study. By the way, this comes right from the international standards, the financial standards board, IFRS. Okay. Let you guys read through this. I don't think I need to read it to you, but I mean, there's questions every now and then on here. So let's go ahead and read the first part here, and then we'll talk about the question. Okay, so small, well, I don't know how small it is, but a family run business of furniture company. I like this, the sales room is attached to the owner's house. This used to be very common. People, you know, they would have the shop downstairs or something, and they'd have, you know, family would be upstairs or whatever. Okay, so been growing rapidly until recently. Challenges. Okay, so possible downturn. Okay, question number one. What is a most serious risk to auditors when their clients are experiencing hardships?
Would it be C?
Yes, very good. Yep. C. Now notice that if something goes wrong with the audit, your audit fees are the least of your worries. You know, and clients probably having loss on their income statement. Well, they have losses; they will have them on the income statement. This one, the more pressure to make profits is probably the most concerning because this might lead to fraud. You know, if the pressure gets enough, it may be the tipping point for a client to cook the books. Okay. Governance. So this is sort of like people that oversee the place. Usually these are the owners, and in this case they are. All right, so just to kind of figure this out, Siraj, I don't know if I'm pronouncing that correctly, but he pretty much runs the place. Juan is, oops, his dad. The family, the company does not have a formal governance structure. So Juan and Siraj prepare the bankruptcy period and meet once a month with a successful local businessman, Ravi. To review their progress against the plan. They also paid Ravi to comment on the practicality of new dreams and ideas, business, blah blah. How to deal with specific issues. So Ravi seems like probably sort of a more worldly business person than maybe the family members. Ravi's daughter is a lawyer. Parvin offers some legal advice, but her two passion lines in marketing. And Parvin's idea was to start selling products on the internet. So you can kind of see here that, you know, father, son, daughter, you know, kind of handing off between the family members. Okay. Yeah. Family run business may have greater audit risk due to which of the following.
Would it be B?
Probably C. You related party transaction may not be fairly presented in the, and here's what do we mean by that? Well, first let's go through the rest of these. Family members might not be paid minimum wage. That's usually not a problem. It can be, but usually not a problem. Family members not be qualified to work in the business. This is a furniture shop. Uh, I would say it's probably not a big concern for this one, anyways. And the family may not trust the auditors. And this is a kind of a funny one because, well, first of all, they have to give all the auditors all the information they need, and if they do that, it's fine. But it's really more for auditors. It's more that the auditors can trust the people running the business. Now, related party transactions. There's a couple of problems with those, and the problems with those is that they may not be arm's length transactions. Sometimes they're a sweetheart deal, or there is the possibility that a family member is buying something at an inflated price to increase the profitability so the place looks like it's more profitable. So you do have these kind of related party transactions. And related party transactions are not just a problem in international standards, they're a problem in US standards. And there's such a problem that companies cannot claim that related party transactions are arm's length transactions. So they cannot put anywhere in, their financial statements or in the notes or anything else that these related party transactions are at arm's length. But by definition, they're not. The related party is not a arm's length transaction. So it could be that either they are paying additional compensation by giving them really good deals, or it could be the other way around, that perhaps they're trying to cook the books through a family member, making a sales to a family member at an inflated price that makes their sales look much better than they are. Could be all kinds of stuff in there too, but that's one of the problems. So related party transactions are always difficult. Okay. Gonna do some spacing problem here. Personnel, full-time 15 employees. 6 of them are related. That's very common. Okay, question 3. Just goofed it up again. Let's bold these. There we go. When an individual oversees all transactions, which of the following audit risk increase?
Is it B?
Yes, very good. Yeah, risk of financial statement fraud. A domineering person is very dangerous in business, because when someone is domineering, they do run the risk of financial statement fraud, and it's because well, it comes from a number of different reasons, but oftentimes when you have fraud, you have somebody who, for example, will not accept that this year wasn't a record year, and oh, well, you got to change the sales because it is a record year this year, and you get that kind of a mentality. Interestingly enough, most people that do those kind of things they don't recognize it. They think they're doing the right thing. Well, of course, it's the right thing to have a record year in sales, and whether it was really a record year in sales or not. But anyway, a domineering person, especially when you have one person that's domineering over the entire operation, a lot of times that can be a problem. And one of the red flags to fraud is one person who's in control. So that's one of the kind of red flags, and that's in any business, not just family-owned business or whatever. Now, in family-owned business, a lot of times there is one person who kind of, oversees the whole thing. That's not that unusual, but it does add a little bit more risk to it. Okay, and here is the chart. So Suraj is the managing director. Arjan is head of sales. Duad, finance, and Demir is the production. Okay, ownership. Jawan is the principal shareholder, 50% of the company's interest. He has started transferring to his son. As long as he continues to manage the company and grow. Raj and his sister, Kalyani, probably Kalyani. Well, 50% interest. The remaining 20% is held by family member Vinjay Sharma. And he's a wealthy investor who will provide capital when needed. Okay, so really goofed up my spacing here. The daughter, well-known singer who travels extensively. In June of each period, Yuan organized formal business. The shareholders probably leave in the afternoon and try to use this occasion to tell the staff how well the business is doing and what the plans for the future are. Okay. So and this is another thing that kind of happens sometimes in business is that you get somebody who doesn't want to do the family business. And here you have a 15% shareholder who doesn't want to do anything in the business, and that's not unusual either. And that's among family members. What do you know? So here's the ownership. Suraj, Kalyani, Vinjay, and then of course the majority to the originator, Jiwan. Okay, which shareholder would likely sue the auditors for an ineffective audit? So we have 4 suspects here that might sue. Who would be the most likely to sue for an ineffective audit?
The daughter.
Could be. I think that'd probably be the second. Actually, either one of these two would be. But yes, she would because she's not involved in the business. So she could certainly, and Vinjay, who is the investor, a wealthy investor who has provided much of the capital, so put a bunch of money into it. This is the type of person that might very well sue if there's a problem with the audit, because they've invested quite a bit in there, and if the audit comes out, it misses something, some kind of fraud or something like that. That's certainly, but certainly the daughter could definitely be in there too, because she's not she doesn't see the day-to-day. Okay. Operations. Okay. They've grown quite considerably through strategies such as, and we can read those or not. Well, actually, there are a few hooks here. Quality products at prices at fair prices to customers. Larger furniture orders from national retailers. These come with firm delivery deadlines and major penalties for late delivery. Okay, so it's possible there are some more risks there because of the penalties. And the profit margins, because these are all identical, I assume, that they're much smaller profit on them. You sell a lot more of them, but the profit is less. They're the first company in the region to sell limited products over the internet. And they're manufacturing stuff for other ones. This is right now an advantage, but this in the future may not be. You know, the more if people see that it's profitable, you might get more competition there. So this is one of those things that, well, at the moment, looks good for the current periods, but maybe in the future, maybe so. They also sell scrap furniture and wood at the factory for cash only. Okay. And exporting to other countries is being considered. Now, here is something to when you're doing auditing, you got to separate a little bit, and that is you say, okay, what does that mean to auditors? They might be planning to sell to other countries. Quite honestly, to the auditors, it doesn't mean all that much. That's a business decision. Your job is to see that whatever those business decisions are, that they're reflected in the financial statements. They're fairly presented in the financial statements. So be careful in that you're not a consultant. You're there to look at see if the financial statements are fairly presented. And to some extent, you can't be a consultant when you're doing the audit anyways. You are there to be sort of the guard keeper. You're not there to be the advocate. In fact, the standards all say you can't be advocates for the client. Okay. So even though this, you say, okay, well, this is more risky, right? They're possibly sell, we don't know how that's going to work out. That's true, but that's a business decision. And when they do it, if they do it, as long as their financial statements are presented fairly, we're fine with it. Okay. Sales. It looks like they're in-person ones are 40%. Still the highest ones. Furniture retailers, that's the one that they are jumped up a little bit. And the rest of these are bringing up the other 30% of it. Custom furniture, internet sales, and scrap. Here's another chart of that, just in case you. Okay, so Arjan. And you recall Arjan is here. The sales director, I guess you'd call him. Is a great deal maker. He's very persistent in negotiations with customers and usually gets the sale, although the profit margins can be slim. Despite the economic turndown, he recently bought a beautiful family home overlooking the valley. Okay, what audit risks relate to Arjan? What are some of the problems that might arise from Arjan? I don't think, I think the more I think about this question, I think is answered a little more down here below. So Arjan, great deal maker, negotiating with customers, although the profit margins can be slim. Despite the economic downturn, he recently bought a beautiful family home overlooking the valley. Okay, what this might be a problem. This is more of a business problem, although it's something you should look into as far as in your audit. Is that first of all, salespeople think really differently than we do. My father-in-law was a sales rep. Anyway, a lot of times, they do thin margins. They're going to pick up the commission, and they actually do get commissions here. So you could actually have basically a salesperson working for themselves rather than for the company as a whole. Now, again, that's a business decision, but that may be something you need to look at as far as just the possibility that there might be something underhanded going on, especially when you have a downturn and you have someone who's very confident. So those usually don't go together. Okay, so and you may look at those transactions more closely, because if they do have thin margins, they may even be for losses that are not adequately disclosed. And we'll talk about it a little later. There's actually something else that comes up on it. Okay. Now, notes on the sales system. Oh, it's right here. Let's see. So sales contracts are for the retail and specialized orders. 2 of the large retailers require Alpha to keep 30 days of inventory on hand so they can be shipped quickly. Okay, so I'm going to underline that one. That's an important one. And these contracts also have provisions for inventory to be returned. Okay, I'm done. I'm not learning how to use a computer. Okay, so we have these 2 parts of these contracts: 30 days of inventory on hand and provisions for the inventory to be returned. What does this 30 days of inventory on hand, how is that a possible problem for the auditors? But what does it mean when they're looking at the financial statements? What do they have to keep in mind? Anyone?
Would it be that there's like 30 days worth of inventory that hasn't been accounted for?
Absolutely right. Yep. Yep, that's right, Courtney. That there is 30 days of inventory. Now, what you have to be careful of is, well, first of all, they should have 30 days worth of inventory, and you can do ratios to see how much inventory they have. The turnover divided by 365. The 365 divided by the turnover will give you the number of days of inventory that you have. So it's possible that they could be in violation of those contracts. Now, one of the things that makes something material is if it violates a contract. Okay, so the violation of a contract has a increased more difficulty to the actual audit, because you not just are you looking for things that are materially misstated, but that also meet up with that contract, which, you know, may be completely different. You have to be careful that that also is an incentive to possibly cook the books. You know, suppose they do their inventory and they have 22 days of inventory. Okay, all of a sudden, you know, they may be thinking we got to do something to make our inventory look like we got 30 days worth of inventory a year in when we really only have 22 days. And so there's also that possible incentive of fraud. Okay. So first thing, said violation of contract. Oops. And second thing is the incentive to possibly create an inventory fraud so that they are not in violation of the contract. So the two problems might be, it might be they're in violation of the contract, and it also might be that there is a incentive for them to create inventory fraud so that they do comply. So it appears that they comply with the contract. Darker so we can read it. Okay, what audit risk relates to the return provision in the contracts? Okay, so they have this return provision. So they sell them the goods, but they also have this provision that if they can't resell those, that they can be returned. What's the problem with that? So they make the sale, you know, they book it. Okay, we sold whatever it was. We sold them the stuff. We book it for whatever the amount was, and then it comes back. What's the problem?
Is it that you have inventory that you've already been like paid for?
Well, it's inventory that'll show back up. Yeah, definitely. Let me show back up on your books. And part of the problem is it may not be a real sale. You know, is it a real sale if someone can turn around and hand it back to you? You know, they're not accepting the risk of it. So sale or revenue, same thing. You know, if they're not accepting the you know, the title to it, is it really a sale? Because they're not accepting the risk of not selling it, basically. And one of the things you'd look at and see is how many of these things were returned, I guess, to see if this is actually, you know, if this is one of those things that's in there and it's never used, well, that's not a problem. But if it is used, then you may have a problem with, are these actually sales that they're having? Okay. Sales orders are mainly filled at the time of sale, except for furniture sold directly from the shop or other items at hand. All orders over 500 euros, or where the sales price is below the minimum sale price must be approved by Arjan. Invoices are prepared when the items are shipped and sent to the customer. Okay, this is a little bit of a problem. Why? You basically have someone checking on themselves. Arjan's the head of sales, and when these sales are below the cost and all that, he, I think it's a he. I don't know, maybe it's not a he, maybe it's a she. Anyway, Arjan can authorize these things to be sold for less than the cost, so at a loss. So you have someone basically checking on themselves. And Arjan also makes sales, so it's a situation. The authorization for that should be done by somebody outside of the sales department. Okay. Number of sales transaction, blah blah blah. Arjan readily performs credit checks on customers. It is a he. He knows most of them. Each period the number of bad debts seem to be growing. All right, so what's a concern for this one? Lack of credit checks and the increasing bad debts. It actually has a lot in there. I'll take this one. This one's kind of a people in sales should never be doing credit checks. It's an incompatible duty. There should be a credit department or somebody outside of sales doing credit checks. And part of the reason is exactly what you is mentioned here, and that is they might approve people to make the sale that they shouldn't be approving, and then you have the problem of, are these really sales? Kind of like with the returning of goods, is this really a sale if you just sold this to somebody who won't be able to pay? Is that really a sale if you're never going to see the cash for it? Okay, so let's number these. So one, the sales department should never perform credit checks. That's a no-no. Should be somebody outside of the sales department. Two, Making sales to customers who cannot pay are not really sales. So when you have, and this, by the way, this isn't a problem just for, this business or whatever. This can be a problem in a lot of businesses where that you're selling to people that you really shouldn't be selling to, and that because those are never going to be collected, those are not really sales. Now, there is somewhat of a control over this. And Siraj reviews the sales and accounts receivable listing. So we do have some control over it. It's not like there's nobody that knows what Arjan is doing. However, first things first, the sales department should not be performing credit checks, and someone else should be doing that. And then also making sales to customers that cannot pay are not really sales. Okay. Let's see here. Each member of the sales staff receives a 15% commission on the sale. Okay, so this getting back to up here, the sales price is below the minimum sale price must be approved by Arjan. You could have him approving sales so that he can get a 15% commission that are below the minimum. And you come down here. Arjan receives by far the most sales commissions. So here you really have somebody kind of just operating by themselves with really minimal oversight. Like I say, Siraj does look over the sales and the accounts receivable for no obvious mistakes, but you really have somebody who's kind of working on their own without oversight. So this is a control weakness, and it's a control weakness that might be hard for the audit because you're looking at things that look like sales that really aren't. And that does affect the financial statements. If they have a bunch of sales that they're never going to collect, those really aren't sales. Or if they have sales that can be returned. Again, those are actual things that affect the financial statements, which you're signing off on. So even though kind of a management thing, it's also a problem for the auditors. Okay. The system consists of 6 PCs, the information technology. The company runs, oops, backups of the accounting system, an external hard drive that is kept in the safe next to the computer room. Firewall protection and passwords have been added. That's good. Last period, 2 PCs were stolen from the office. Access to the office is now better secured. The PCs are chained to the desks, and the server is locked in a separate and specially cooled office. Okay. Number 9, why is keeping backups only in the safe a possible problem? So they take the backups, they put them in the safe. They say, well, okay, we need to keep these, secure. We'll put them in the safe. What's the problem with putting the backups in the safe?
If something happens to the safe, they're gone.
Exactly. And this is not uncommon too. People put the backups in the safe. Someone breaks into the place. Well, what do they take? They take the safe. Not that they want your accounting records. They really don't care. But so something in the safe, if that's the only place you're keeping it, is usually a bad idea. You could have a fire. If the safe isn't completely fireproof or something like that. You can run into those kind of problems that if it's in the safe, it could very well be damaged, the backups. And if you have a fire, your computers are all burned up, you go the backup in the safe, so you open up the safe and it's all charred in there. And so keeping something in the safe, and a lot of times even keeping it on site, is not always the best idea. Not a bad idea to have two backups, have one that you put someplace else. It's not it's a good thing to have, especially for a smaller business that doesn't have, the wherewithal. Nowadays, keeping on the cloud is the obvious solution to that. You back it up to the cloud. But so one, uh, and two, I would probably say, day backing up to the cloud is a good procedure to do, and you might do both of them. Wouldn't be a bad idea to do both of them, to back them up and then also back up the cloud in case the one on the cloud got uh you know you had a problem with that or something like that. So it's not a bad idea to do both of them. So yeah, a safe being stolen or burned in a fire is one reason why you don't always put them in there. Okay, let's stop here and then we should be done a little early today. We'll see. So let's stop here. We'll go to human resources. Let's say be back at, what time is it? 6:56. Well, let's say 7:06. Okay. Uh, human resource and payroll. Employees are paid in cash at the beginning of each week. Employees sign a list when they pick up the. Now, to us, paying employees in cash is a no-no. You have to keep records and withholding and all that kind of stuff for employees. So you look at but this is, I'm not sure what country is this, India? I don't know if they say what country it's from. But anyway, it's possible, very possible that in whatever country it is, that they don't have any rules on that. Now, that doesn't mean that it's not a good idea to keep records on employees, but paying in cash in a lot of, well, in the United States, I used to be an auditor for U.S. Steel, and U.S. Steel used to have, it still does, the buildings that would have vaults that would literally be 20 feet by 20 feet, giant vaults, walk-in vaults, because they'd have cash in, and people would come to work, they get a tag, tag number 78372 or whatever. They'd work for 8 hours, they'd bring back the tag, they'd give them the tag, and they give them cash, and they walk out, and no one didn't know who they were or that they were there, whatever. The next day they'd show up for work, they get another tag and go in, and they used to have loads of cash just sitting there in these giant rooms, because that's just the way they did business. And we're talking about U.S. Steel, we're talking about thousands of people every day. So while it might seem a little strange to our, to nowadays thinking about it, that was not that uncommon especially for developing economies. It's not that uncommon. Now, as an auditor, you might look at that and say, well, I really think you ought to keep the records, but yeah, so it does relate have some problems here. As an auditor, what would be the problem that you would come to your mind immediately? That they're paid in cash and there's no records kept. Employee records, I should say. You think about the financial statements. What would be a question about that?
There'd be no wage expenses on the financial statements?
Exactly. What are the expenses? I shouldn't say accurately, fairly presented. Because it's done in cash. And, to our, in the United States, we have a saying that, cash is for crooks. Well, in a lot of places, if you don't get paid, if you don't pay the people cash, they're probably not going to show up the next day. It's just the way it is. So, are the payroll expenses fairly presented? This is one of those times that, even though it may not be required by law, as an auditor, that's probably something you'd like to see so that you can verify the payroll expenses. Okay. I don't think the purchasing, there's nothing too crazy about the purchasing. There is something a little crazy. Hold on a second. Do here. Accounting and finance has some. Okay, so Duane, as you recall, this is the accounting slash finance slash IT guy. Yeah, here. You know, this is Duane. Put it in an accounting system. Good news. 2 years ago, I want to say something about accounting systems. If the accounting system is new, there's generally that increases the risk. So if you have an accounting system that is new for the year you're auditing, that increases the risk. As time goes on, now you get into the second year, they probably have it all ironed out. But a new accounting system increases the risk. In this case, it's not new; it's 2 years old, so they're probably okay with this. You know, usually by you get 2 years, usually you work out most of the stuff. Okay, notes on the accounting and finance function. The company does not have a perpetual inventory system. It's counted twice. This ensures profit margins on sales can be accurately calculated at least twice a period. Dwight has been frustrated over the lack of controls of the inventory. Suggested the inventory be counted 4 times. Sure, and Siraj had overridden recommendations saying that it would be too disruptive to count the inventory so often and could cause the company to miss deadlines. So again, this kind of a management decision there. Now coming down here, although it hasn't been profitable, the margins have been inconsistent. And because of lack of information, yeah, it's hard to tell why they're doing this or why they're not being tracked by the product line also. So inventory costs not being tracked by the product line, that is a problem because you don't know if a product line is profitable or not. Okay, why are erratic profits risky for auditors? You just realized 13 is nothing is 13 is a copy and paste problem from number 12. 11 though, why are erratic profits risky for auditors? What does it indicate? The biggest thing it indicates is that the costs or revenues may not be adequately being tracked. That's why you get these big swings. That you don't have an accurate income, basically. When these financial statements come out. So So erratic profitability may indicate that the accounting system lacks the accuracy necessary. May lack the accuracy necessary to produce fairly presented financial statements. In other words, it seems unlikely that if you had huge swings, that was due to actual conditions. You know, it'd be very strange to have a very profitable March and a very unprofitable, April, and then a profitable May, and that just seems very unlikely that would actually be those would be the actual swings, for a business. Usually they have trends. They're not erratic. They have trends going on. So this, whenever you see something like this that's erratic, it immediately says that there might be a problem with the system, and it could be someone manipulating it, but it also could be just they don't have the accounting system isn't accurate enough to put out financial statements you can rely on. Okay, and when inventory costs are not adequately tracked, what risks increase for auditors? This is kind of obvious that the inventory and cost of goods sold accounts are misstated. They may be misstated. Okay, question 13. Siraj gets very annoyed at having to pay any form of income tax and usually presses Jawad to ensure that accruals are more than adequate. Okay, this kind of goes back to, the dangers of having someone who's someone who's overbearing, someone who is controls everything basically. So I didn't ask what the question is. It's kind of like Jeopardy. You have to ask the question for what the answer is. Okay. Okay, why is that a problem for the auditors? That's actually a question. This is a red flag for fraud, in that the pressure is coming from somebody who is basically putting their own will on somebody else to create a fraud. Basically, I'm gonna leave it at that. Now, there is a little bit of a silver lining to this one, though. It sounds odd, but I'll tell you what it is. So, Siraj does not want to have to pay any income tax. Whatever reason, he hates them. He doesn't want to pay them. He'll do anything not to pay them. Okay, so generally in auditing, when do you get sued for an audit? You generally get sued when a company's doing worse than their financial statements indicate. You know, they say they're profitable and when they're really not. That's when you get sued. Okay, so, you know, I'm saying you generally don't get sued the other way around. Whereas if you put out financial statements and the company is actually much more profitable than it shows in the financial statements, it's very rare to have a lawsuit on that. Reason being, what's the loss? You know, any investor that was in there, you know, it's more profitable even than they thought it was. You can't, you know, there's no claim there, and that's kind of where this is. You know, he's trying to make the company look less profitable while putting pressure on and cooking the books. Yeah, that's bad. This is actually one of those things that, and they won't tell you this in the standards, but it's one of those things that is not as big a deal as you might think, in that the auditors look at this and they say, well, in a weird way, that makes the audit less risky. Because if they are making themselves look less profitable, we're not going to get sued for that. No bank is going to say, hey, you know, I gave a loan to these people and they're much more profitable than I thought it was. You can't get sued for that. You know, what are their losses? So in a weird way, someone who wants to avoid taxes, it kind of plays into a little bit of reducing the risk. However, still misstating the financial statements is something you have to look into. And if it's material, you know, then you certainly have to do what you need to do to make sure that they can be relied on. Okay, the last two here have to do with looking at the financial statements. Okay. So what will happen when you do an audit, is management will give you the financial statements. In this case, we just got two of them. So here's the income statement. They give us the income statement. These are usually labeled at the time as unaudited. So they'll give you the financial statements. They'll be labeled as unaudited. And that will change when you do the audit. And so one of the things you do as an auditor is you look at the financial statements and kind of go over them and see what things that look like they are things you need to look at. What looks unusual about these financial statements? So let's just go ahead and take the income statement. Now, these are the years here. So 2 years ago, these are their sales. 1 year ago, those are their sales. This is, you get the idea. All right. What would raise your concern looking at this income statement?
Their net income is almost double what it was the previous 2 years.
Yeah, income has jumped up. even pressuring the finance guy isn't gonna, you know. So income. It's more than doubled, right? What else looks a little bit strange here? Now let me look at some. Let me show you some things that maybe, if you think about what we have here, it may not be so strange. Let me look at the taxes and say, oh look, the taxes doubled, but that would, that does seem plausible. That if your pre-tax income more than doubled, that your taxes would more than double. So, well, the income doubling is certainly eye-opening. These would kind of go along with that. What else looks a little strange here? Oh, hey guys, hey, look at this. Remember, oh, what was his name? Jawad, remember he came in 2 years ago? Look at the depreciation costs. 2 years now from last year to this year they didn't do it, but so you got pressured to depreciate things much more. Uh, this is when Jawad came on, so. So what things look a little strange looking at all these? There's actually one account that kind of jumps out. Well, actually two. The one that's that really jumps out is this. I mean, this is crazy growth. So the 1,437,000. Seven divided by 1,034,322. 39% increase in 1 year. That's massive. Cost of goods sold jumped up, but you'd expect that with the sales jumping up that would. This is the one that jumps out to me also, this one. The administrative expenses. It's not 39%. Ah. How to use a calculator. So about a 56% increase. Oops, wrong. So these are kind of things that would jump out at you. Income more than doubled, definitely. Sales are increasing by huge amounts. Administrative expenses. I don't think did we read anything on the administrative expenses that it caused them to jump from about 200,000 to 300 and something. I don't think I saw anything up there. Anyway, yeah, so now looking at this, so let's look at the things that we looked at to investigate. Okay, are these evidence of fraud? Sales jumped up 39%, administrative costs jumped up 56%, net income jumped up over 100%, more than doubled. Does that mean that there's a fraud here? What do you think? And call the police? There's a fraud here. When you look at the financial statements, these are what they call analytical procedures, and they simply tell you where to look. They do not tell you specifically that there's fraud. So this, what these are called are analytical procedures. And these indicate where auditors need to investigate. They do not, in and of themselves, usually indicate that there's a fraud. This administrative expenses, they may have just jumped up. It's not completely out of the question that they would do that. So they tell you where to look. They don't necessarily tell you that these are fraud. So analytical procedures, they indicate where to look. but they are in and of themselves, they're not proof of fraud. They just tell you where to look. And something like 95% of fraud is found through analytical procedures. They say, go look at this, you go look at that, and that's where you find the fraud. So it isn't that they are worthless. Well, they don't tell us where the fraud is, or they don't, if they're not proof of fraud, why do we even do them? Well, because they tell you where to look. So you look at the financial statements, and you're looking for what we call plausible relationships. You know, sales going up by 39% doesn't really seem plausible. Administrative expense going up by 56% doesn't seem plausible. Income doubling, especially since they're having supposedly a downturn, doesn't seem plausible. Okay, let's go to the balance sheet, and you'll do the same thing. And there are a couple of numbers that jump out on the financials, on the balance sheet. And I'll even narrow it down a little bit. It's in here. What number's in here? Don't worry about the number. What accounts in here would make you want to be interested enough to go take a look at them? Anyone?
Would it be the prepayments?
One more time.
The prepayments?
Prepayments could be, and certainly for whatever reason they were much higher before, and I think those are those 15%. Could be wrong. Hold on a second. I'm talking about 15%. They had a custom furniture at a 15% down payment or something. I don't know, but yeah, the prepayments are certainly something that you would think if the sales are increasing, right, you would think that those prepayments would also be increasing. Whereas you look back at 2020, their 23,000 dropped in half, and they're still way down. So yeah, that would definitely be one you want to look at. The one I was, well, that one too, but there's actually almost everything on here is kind of strange. Trade and other receivables jumped up quite a bit. You know, remember, these are accounts that are not collected. So 67, I don't know what that is. It's probably 50% increase, somewhere around there. And these are not collected. Now, the reason why that is a little bit concerning is that might indicate, you know, since those are not collected and it jumped up, that some of these sales are not real sales. You know, if these jump up, it's possible that these are never going to be collected. Inventories jumped up. Now, inventories will jump up with increase in sales, which we have here. So this one's not as unusual, but those did jump up. Cash is a little unusual too. Your income jumped up, your sales jumped way up, you know, and your cash goes down. Nothing else here is too crazy. So I would say, yeah, certainly the prepayments are kind of strange, and certainly the receivables, because they jumped up so much, more than the increase in. Well, let's see if there's more than the increase. I think it's more than the increase in sales, but I could be wrong, although that's never happened before. So plausibly, you'd think that if the sales jump up, that the receivables would jump up by the same amount or something similar to it. Yeah, this is 60%. So you have a 60% increase in trade and other receivables, so in receivables, but you go up here and in our sales, we have a 39% increase in sales. So the increase in those accounts receivable, the accounts that have not been collected, is 20% more than the increase in the sales, even though the sales jumped up quite a bit. Yeah, and certainly there's these prepayments from customers. It is very strange that 3 years ago they collected twice as much basically as they did in the last 2 years. So the prepayments is also. Yeah, and this is especially odd. The decrease in the prepayments is especially odd since the sales have really jumped up. The sales have increased by 40%. A plausible relationship would be that those prepayments would jump up by 40%. So that's a really odd one. Okay. I might talk a little bit about these documentation. One of the things you always want to go through and see if you want to keep a client or considering to take another client. I'll leave these with you, but I'm going to kind of just summarize it because it is a little bit strange for our profession. Here's the weird thing about auditing. It's a profession. It's like being a doctor or a lawyer. Unlike being a doctor or a lawyer, there are a few more wacky rules. One of the rules is that you have to be independent from your client. If you're a doctor and your brother gets ill, you can help them. I mean, you're actually required to help them. If you're in auditing, my brother needs to have an audit. I can't do it. I'm not independent. So it's this weird kind of a profession that you have to be independent from your clients, which there's hardly anything in the world, other professions like that. So you have to be independent from your clients. Another weird thing is that you don't just take any client. If you cannot be associated with people of ill repute. So if there's a problem with management for whatever reason, makes you question their integrity, you can't take it. And that's different from other professions too. A doctor, if someone comes in and they're a bad person, if they're a good person or whatever, it doesn't matter, they're going to help them. They're required to help them. That's not the same with us. We pick and choose who we associate with. you know, even lawyers, someone comes to them and say, yeah, I just killed 5 people. Hey, come on in, let's talk. You know, it's very different for auditors, because auditors, we cannot be associated with it. And the reason is we give credibility to the financial statements. So if we are associating with people of ill repute, people who do lack integrity, it's not only going to affect, you know, our audit, that particular audit is going to affect everyone's audit, because audits will mean less if the auditors are associating with these people that they shouldn't be associating with. So it's a very weird profession, and that's what, you know, accepting a client is a big deal, and that's why we have these, you know, this big checklist of stuff to go through for, for accepting a client. You know, it's not like McDonald's. Someone comes in and orders a hamburger, and you say, "Sure, I don't care where you're from. Here's your hamburger." We don't do it. As you go through here, you know, real big on independence, real big on if we can trust, you know, the client. So, yeah. For instance, here's one of the things that was in the we shouldn't have done that. The daughter of the Parvin, the lawyer, was an advisor on a land deal, which officials were accused of receiving bribes from the developers. So this is one of those things that might say, okay, wait a minute, we can't be associated with someone who's involved in a business deal where they, you know, bribes were paid to officials. It depends on, you know, the extent of it and what they're involved in, all that kind of stuff. But yeah, so it's kind of a weird profession in that. So but I'll leave it with that. So anyway, so next class. So here's what we're going to do from now on. We're not meeting next week. Okay, next week is off, fall break or Thanksgiving or what we're going to call it. We're off for that, and so we come back. So this is what, week 12. So week 13 we're off. Week 14 we come back, and I'm going to do the I'm going to do chapter 12, which is sustainability, and I'm also going to throw one more thing in there, the Sullivan principles, which we'll talk about in 2 weeks. And then that'll be it for the class, and then we'll just have the last test, and the last test will be over chapters 10, 11, and 12. Any questions? Okay, have a good week. I'll put a drop for this in Blackboard, and I will see you in 2 weeks. Have a good break.
Happy Thanksgiving.
Thanks, you too.
Thanks.